With corporate insolvency numbers spiking at a touch over 11,000 last calendar year, we're going to spend a bit of time talking about what we're seeing in the marketplace in terms of what kind of appointments and the drivers that are causing that spike in appointments. Beck or Chris, would you like to lead off?
Yeah, probably from my personal experiences over the last year, I have found that there's definitely been a ramp up of corporate insolvencies from the construction industry. And that's obviously off the back of quite a number of residential developments in Queensland, but I think that's across Australia as well. That's probably a similar theme. The other space I have noticed is in the pharmaceutical industry. Obviously, off the back of the merger between Chemist Warehouse and Sigma, then that's probably resulted in a couple of the smaller pharmacies suffering from some financial distress. So, yeah.
Mostly terminal, or is it a turnaround?
Turnaround, yeah. I think that's probably where it's starting at the moment. I know that a lot of the law firms are currently doing security reviews of quite a number of, that's across all industries really, but off the back of that, I would imagine that there would be formal appointments that would result from those kinds of security reviews.
Yeah, it's an interesting point. 2024, 11,000 formal insolvency appointments, about the highest it's ever been, but a lower proportion against, say, the GFC, where there were less firms in the market. If you look at how it's tracking this year, there's been 7,500 to December. And so you can see easily that's tracking to something like 15 or 17,000 as they usually uptick closer to June. Construction insolvency is leading the way. Probably what's interesting in those numbers, though, is the breakdown between different types of appointment. Are you, Chris, seeing anything in terms of SBR or the mix of voluntary liquidations, voluntary administrations?
It definitely comes across that SBRs have become much more preferable in the SME marketplace. And I think that's driven by the fact that it's more cost-effective means of restructuring an organisation, so more potential for it coming out and being rehabilitated. Conversely, there has been a huge spike in CVLs and court liquidations, and I think that's more a focus of these entities aren't profitable, aren't salvageable, and they're more terminal liquidations. And I think that's where the real spike has been the last year. And my belief is probably it's been driven principally out of the ATO in terms of driving corporate debt recovery actions. I think the ATO doubled its debt from 25 billion to 50 billion since COVID years. So they're actually taking active steps and driving some of those appointments.
Yeah, and I think also taking further action with the director penalty notices for outstanding superannuation is probably an area where they've gone pretty hard post-COVID to try and recoup some of those costs that have just built up over a number of years.
It's an interesting strategy. Rather than pursuing the entity, they're going after the individuals. So I think last calendar year or financial year was 24,000 DPNs. So that's 24,000 directors receiving personal liabilities of company debts. And that's a scary proposition for an individual.
Yeah, I think that's definitely driving that SBR increase as well. I think 2-3 years ago there was 70 when it first came in, and that went up to 1,000 to 1,500 to it's probably tracking to something like 3,000 this year. That changes the mix of work for firms as well. Less of the CVLs, more of the SBRs, that a lot of them are having a positive outcome. There's some talk of that limit for the SBRs increasing to 5 million, I've heard. I don't know what you think about that, or whether that would be a worthwhile change to the law.
I'd be interested to see what the outcome of SBRs are. So how many firms actually survive for another 2 to 5 years after going through a restructure through an SBR? Is it more efficient or effective than the voluntary administration regime? And I think that's the big unknown at this stage, because SBRs are still so young.
Yeah, and I think it comes down to the advisor and the negotiations that they make with the creditors to try and further reduce the debts that are owed. I think a couple of experiences that of SBRs that I've been involved with, they've negotiated pretty hard with the ATO to try and reduce the level of debt that's owed, and been able to successfully do that.
Definitely. And I guess the interesting point about, you talked about the negotiation with the ATO, there's a great role for the external accountant to be part of that. But the ATO over the last couple of years has been pretty generous in terms of its payment plan arrangements. I think up until 18 months ago, you could get 3-year payment plan arrangements, no real lump sum upfront payment. I think it's gone back now to the pre-COVID days where payment plans have to be within 12 months, have to have a lump sum payment up front. And I've even heard, again, ATOs asking for security over personal property for some of these payment plans. So whether that impacts the ability to execute SBRs, I think would be an interesting point to come out in this calendar year.
And so probably at the other end of the market, you mentioned, Beck, the security reviews that lawyers are doing on behalf of banks. Is there any specific industries that you're seeing there?
I mean, off the back of the GFC, where the Banking Royal Commission had come into effect, that pretty much dried up a lot of the security appointments, the way they enforce and take action to appoint receivers. I'm personally seeing a lot of a shift in that now, where it is the banks taking more enforcement action because of the fact that they have given the companies a wider berth to be able to potentially recover from COVID or some sort of cash flow constraints or whatever, but then they're not able to still meet their debt and covenants requirements. So therefore, it's probably the fact that there's going to be the security review will be the initial stage, and then potentially like IBRs or reviews where they appoint or potentially approach the company, and the company may come to an advisor like us.
I think over the past, out of the Royal Commission, and so probably over the past 5 or 10 years, you've definitely seen the banks have been still reluctant to make receivership appointments generally. I think that's picking up a little bit, but the second, third, fourth tier lenders, they're less concerned about that reputational risk. There's more appointments that we've seen coming out of them. Chris?
You're right. The mid-tier financiers have been definitely more active. I think anecdotally I've heard the biggest inflow of files is not so much corporations, but high net worth individuals that have over leveraged themselves for property redevelopments and extensions and renovations. And you would think that that's an indicator that their businesses might also be on the verge of getting in that bad bank side of the business. So it'll be interesting to see, I think, the next 12 months in Melbourne. But I don't think the flow-on effect has hit us as yet.
Yeah, I mean, looking specifically at construction, if you look at those, again, the ASIC statistics, far and away the leader in informal appointments remains construction. I mean, the difficult businesses to manage, they've been hit by inflationary pressures over the past few years, again, coming out of COVID. They might make money on a particular development, they might not. The cash flows are lumpy. New South Wales in particular, there's been some difficulty around a whole lot of residential and large residential apartment builders and the new legislation there. Similar, you're seeing that sort of activity in the construction space in Brisbane or Melbourne?
Definitely Melbourne, the apartment construction side of the industry is really struggling. I think you'd find a lot of operators nationally sort of exiting Melbourne and focusing on other states for their future projects. I'm not really sure what the drive is that, if it's the property downturn in Melbourne maybe being part of that, or also the, restrictions on migration coming into the state and Australia generally. That could also be a driver as well.
Yeah, I think from Brisbane's perspective in the construction space, obviously with the multiple floods that have occurred over the last 10 years, a lot of developments and more concentrated areas like inner city of Brisbane, they've had to actually raise the foundations of those residential unit developments to be able to comply with the new flood requirements, and that is not something that they would have otherwise factored into the original contracts that they have with the homeowners. So and I know that there's been a lot of changes of recently where they can now go back and change the price that's stipulated in the contract because of these additional costs to attempt to recoup, but they're still operating at very, very low margins, I think, and therefore they're relying on the fact that they can complete the projects on time.
What we've seen is developers having builders, large developers, the builders coming to them and saying, look, I'm out of funds here. The costs have gone up since I quoted these jobs a couple of years ago. In the absence of you providing me some relief here and putting in some extra funds, it's going to be a challenge and you might need to put a new builder in. And so the developers having to sit back and make a call and say, okay, am I going to inject some extra funds here? Or do I have to then alternatively go through the process of trying to novate to a new builder who's then going to come in and need to rework, rescope anyway? I think all of that's levelling off a bit, but there still seems to be a high level of activity for us in that sector.
So does anyone have any thoughts about what the next sector will be that will be struggling or will see an increased incidence in insolvencies?
There's been a lot of food chains and like in the hospitality space where they've opened locations across Australia, and then as a result of opening all these stores, having that footprint across multiple locations, the rent can be quite high, especially if it's in the likes of Westfield, like big retail spaces where they've actually closed all the locations around Australia as a result of going too big too quick, which I think is not necessarily just limited to the hospitality sector. Any franchise businesses, I think, generally struggle with that. Or when do you grow and when do you change and shift with the times? But I think sometimes it's probably more so the hospitality space because they can only, I suppose, charge so much for food and drinks to consumers.
And it's probably coming at a time where consumers are cutting back, impacted by interest
right.
rates, wage growth. That discretionary spend is probably being a driver of hospitality struggling in certain pockets around states and the country.
I reckon businesses in Melbourne, if they survived COVID, then restaurants and that, if they survive COVID, now they're just trying to obviously get the repeat customer base. So
the ones that didn't do any adaptation and hoped for things to go back to the pre-COVID days, I reckon they will be the ones that struggle going forward. Do you see any particular unique industry in New South Wales that might be more likely to struggle compared to the rest of the nation, Chris?
Sydney and Melbourne, there's a higher number of funds providing capital to tech businesses, things like that, where a lot of those businesses where go back to COVID in particular, where there were big valuations, there was money being raised easily, sort of just coming out of that started to become pretty difficult pretty quickly. And so what we are seeing is tech businesses in particular that have previously they might have had a bit more runway to try to get to a sale or to develop out a product that they're trying to finish to go to market. And some of them are just running out of time now.
And what's the main exit? Is it to complete the project in order to then be able to sell it? Or is it to find an overseas tech company that might be interested and cashed up to purchase it?
Yeah, I think it's either of those, or if in the success story it's getting to market and then being able to raise capital and maybe take the business public. If they can't do that, then it's trying to get to some sort of point. So there might be a sale, and if they can achieve a sale earlier on, but you've seen businesses that run through these processes that they'll run a sale process that's unsuccessful, then they'll run another one, and that each time the valuation goes down and down. And these are businesses that have sometimes raised in excess of 50, 100 mil And so there's mainly shareholders, but then there'll often be a secured creditor in there who's owed, again, a not insignificant amount of money. And, all across that level, there's people that are struggling to get good returns.
I would imagine it's such a niche area to be able to determine what the value is, but also whether or not it could be recoverable, depending upon what stage it's at.
Yeah, that's right. I mean, if there is going to be a purchaser, it's often going to be a trade acquisition, a company that's in a similar part of the market that sees something that the company's done and said, I like that, I want to pick that up. But you're right, the challenge partly with those businesses is they're reliant on the staff who are highly knowledgeable about specific, their code or whatever that's been developed. How do you actually put your foot on that, make sure that it doesn't go off elsewhere and be sold or used by somebody else? There's challenges around it. How do you, if there's a website, there's ongoing costs so you're talking about potentially a funded administration or receivership to get the best result. In a shutdown, it's going to be tougher, and you need to try and get to a sale quickly.
Especially with a lot of startup companies not getting as much, I suppose, of that government funding as potentially what they were getting in the early stages, or having to obviously ask for private investors to be able to go out to market. It can sometimes be a bit more challenging to get it that way.
And I think on that point, any sort of organisation relying on government funding might struggle going forward. I know certain states, particularly on the eastern seaboard, have got budgetary constraints coming up. We've got an election coming up where our economy may not be doing as well as hoped. So I can't imagine there'd be a lot of spending promises coming forward. So that could be another segment of the market that struggles over the next few years.